Hello guys, so in this tutorial, we're going to talk about the accounting equation. Okay, so the accounting equation goes like assets is equal to equity plus liability. So what we're saying here is that assets are those things that you have bought and that you've acquired, basically. So equity is what you have contributed, and liabilities is what you have borrowed from others. So for instance, you're starting a business, you have to save some money so that you invest in the business. Usually when you're starting your own business, you need some money. So you can invest some money that you have saved yourself, or you can actually start a business together with the help of some of your friends. So you put resources together, and then that forms your equity. Now, liabilities comes in the sense that you're now going to borrow from banks. Say what you want to buy, the amount of money that you have is not enough for you to buy all the assets that you want in order for you to run the business. You might want some mortgage, so you go to the bank and then you negotiate a mortgage agreement on that. So those are liabilities because you owe. So liabilities, we are talking about what you owe other businesses, what you owe others. Those are your liabilities. And your equity, we are saying what you have contributed yourself to the business. So that's equity. So if we add what you have raised yourself plus what you have borrowed from others, together, we get enough money to buy all the assets that you have in your business. So assets is equal to equity plus liabilities. Whatever you buy an asset, it's either going to be financed by your own funds or you are going to borrow from other people. So assets should always equal equity plus liabilities at all the time. So another important thing that we need to know here is that assets increase on the debit side. So assets increase on the debit side. So if you want to increase an asset account, you're going to say you buy a new asset, you're going to open an asset account, and then you go on the debit side, and then you increase the asset. Equity increases on the credit side. So if you introduce new capital, you're going to credit the equity account. So the more you credit the equity account, the more it increases. The moment you just introduce money or add more money or make more profit, all that adds to your equity. So equity increases on the credit side. And then on the liabilities, the same applies. When you borrow money, you're going to increase that on the credit side. It also follows that on liabilities, that when you repay the liabilities are going to decrease, but then decrease on the debit side. Remember, we said the entries that are written here: debit assets, credit equity, and credit liabilities. This is where these accounts increase. So if an asset account is increasing on the debit, it also follows that it decreases on the credit. If it's a liability account, we say it increases on the credit. It also follows that it decreases on the debit. Same applies for equity. So debit assets when you're increasing, credit assets when you're decreasing, credit equity when you're increasing the equity account, debit equity account when you're decreasing. On liabilities, you credit the liability account when you're increasing, and then you debit the liability account when you're decreasing. So you also see that this equation is called the double entry system in accounting, which means that whenever you are entering a transaction, it has to affect at least two accounts. So you either debit and credit. You're always debiting and crediting for each transaction. So you debit the account which is increasing and credit the account which is decreasing. So for instance, you buy an asset for credit. This follows that, well, in this case, we can conclude that the assets are going to increase. And then the liabilities are going to increase as well. So I'll give an example of a case whereby you buy an operating building, so you want a mortgage loan. So in that case, you're going to debit your asset, which is your land and buildings, and then credit your liabilities, which is mortgage loan. Okay, so in that case, you've affected two accounts. When you introduce new capital, you can introduce it as in form of an asset, or you can introduce it as cash. That's still fine. So in the case that you're introducing new capital to the business, you are going to credit the equity account to increase it, and debit the asset account in which you've introduced the capital phase. So if you introduce your own motor vehicle to the business, you're going to debit motor vehicles account to increase it because you now have more vehicles. And then you're going to credit the equity account because the equity increases on the credit side. So you credit it. And then, so that's how it works. Sometimes you can buy an asset. You can introduce capital in as cash, which simply means you're going to debit the cash or bank of the business and then credit your equity account. You can also use the money that you brought into the business, like which is in your bank account, to buy an asset. In that case, it means that you have to debit the asset that you're buying. Say you use the cash in your business to buy furniture and equipment. So you debit furniture and equipment because it's an asset which is increasing. So you debit it. And then you credit the account that is going down. And in this case, it will be cash or bank because you're decreasing your cash or bank. So debit assets, these are just examples of non-current assets that you can have in a business. You can have land and buildings, you can have equipment, you can have motor vehicles, investments, and goodwill. So all these are non-current assets that you can have in your business. Non-current assets are in the business for more than a year. So if you have assets that you are acquiring for the purpose of helping you in running the business, you have no intention of selling these assets. You have the intention of keeping them for long-term purposes so that you operate the business using those assets. For instance, if you have land and buildings, your intention, if you're not a real estate agent, of course, your intention is to operate from the land and buildings, maybe to build your factory and operate from there. So you Okay, so we're saying non-current assets are assets with a long-term life in the business. You are acquiring them for the purpose of helping you in running the business. You do not intend to dispose of them anytime soon. So for instance, if you acquire motor vehicles, you're acquiring these for the purposes of maybe delivery vehicles. So you want to use them for the purposes of delivering, and equipment, you want to use it for the day-to-day operations of your factory. So that's long-term in nature. So non-current assets are in the business for the long term. So that's the issue there. Okay. Okay, so non-current assets are in the business for the long-term sustenance of the business. And then another group of assets that we can talk about are the current assets. And when you talk about the current assets, we're talking mainly of your inventories. This is your inventory of whatever you're trading in. It could be inventory of items that you're trading in. Like I said, it could be your loose tools and other smaller items of inventory like stationery, etc., that you've got in the business, and then trade and other receivables. These could be when you sell on credit, and some of your customers might not pay immediately, and that forms part of your trade and other receivables. Prepaid expenses. This is when you pay an expense in advance before it's time. So maybe you have prepaid your rent for the entire year. That creates a prepaid expense because you now have you are now owed a service. You're paid in advance. It's you who have paid in advance. An expense does not create either a prepaid or accrued if it is paid on time. The moment you pay in advance, it creates a prepaid expense. The moment you fail to pay it on time, it creates an accrued liability. But we're going to talk about that as we go. And then accrued income, this is when someone owes you and they have not paid you yet for the services already rendered or for goods already delivered. So that's an accrued income. It's due to you, but it has not been received yet. Cash and cash equivalents, that is usually your bank or your petty cash that you have on your premises. Okay, and then these assets, you're keeping them in the business for a period of less than a year. So when we now go to equity, we've already said that equity increases on the credit side, and then we've got the capital that the owner has introduced to the business. If you also introduce additional capital during the year, it will be added on there. And if you make a profit in your business, you're also going to add it on there. That's equity. And then equity is reduced by drawings. Drawings are a situation whereby the owner is taking money for personal use. So drawings reduce equity. Therefore, we debit drawings. So drawings have a debit account. The more the owner draws the money, the more you debit the drawings account. The more the owner introduces new capital to the business or new equity, you put it in the credit side of the equity account. Okay, and then talking about profits. Profits now are affected by what we call the nominal section. The nominal section is what you see in the statement of profit and loss, and we are talking about incomes and expenses that the business incur when it's running. So the overall effect of the incomes and expenses is felt on the equity of the owner through profits. So the more you incur incomes in your business, the more your chances of getting higher profit are. So when you get your incomes, you get your income from sales. So if you make more sales or revenue, you're getting more to the business, which is likely to increase your profits. Commission income, if you're earning commission income for maybe you're providing consultancy services, and then you're earning a commission on that, that also increases your profit. Your rental income, maybe you're renting a section of your business to other businesses, that brings you rental income. All those incomes will increase your profits, therefore they increase on the credit side. It also means that when you want to reduce these accounts, you're going to debit. Profit on disposal, this is when you sell a non-current asset, and then the difference between the selling price of the non-current asset and the carrying amount in your books makes profit on disposal. You can also incur a loss on disposal, and that is an expense. We're going to talk about expenses very soon. But profit on disposal is when the selling price of your non-current asset is higher than the carrying amount. The carrying amount is the cost less accumulated depreciation. So when the selling price of the asset is higher than the carrying amount, then you've got a profit on disposal. Discount received, this is when you have bought some inventories and the supplier decides to give you a discount. And that discount received will be a credit balance because it's income to you. Interest income, you are earning interest on your savings on a fixed deposit. That is income to you, therefore it will be on the debit. And then on the debit, so the interest income will be on the credit. And then on the debit side, you're going to have expenses or anything that reduce your profit, like your cost of sales. When you incur cost of sales, you are basically saying the cost of the items that you're going to sell. So that's definitely going to reduce your profit. In a way, since your profits are on the credit, cost of sales will definitely be on the debit. So cost of sales will reduce your profit and therefore should be added on the debit. So the higher your cost of sales, the more you debit. Depreciation is an expense. All expenses may have debit balances because they reduce profit. All expenses reduce profit, therefore they have debit balances. All incomes increase profit, therefore they're going to have credit balances. So expenses that you can expect to see when you're starting accounting, depreciation, telephone expenses, rent expense, water and electricity, discount allowed, interest expense. So all these expenses are going to be increasing on the debit side. So whenever you incur a discount allowed, this is when you have sold goods and you've allowed a discount to someone. The discount allowed account, you're going to debit it. So this is how you deal with it. All expenses are going to be on the debit, and all incomes are going to be on the credit side. And then coming to liabilities, liabilities can also be classified as non-current liabilities, which are mortgage and long-term loans. And these liabilities, which are long-term, are the part of liabilities that you're going to repay in more than a year. And the current liabilities are those that you intend to repay in the near future. And these are made up of trade payables, which is basically your sales, your purchases from your suppliers. So when you buy goods from your suppliers, they are called trade payables because you have to pay them. Say they are giving you some stuff on credit and then you're selling them in the shop, and then after you get some money, you then pay. They can give you a credit period, say maybe 30-day credit period. So trade payables are what you owe your suppliers. And then you might also have accrued expenses. These accrued expenses, this is a situation whereby you have not paid your expenses on time. And when you have accrued expenses, it is a liability because you then start owing. An expense in general is not a liability if paid on time. It only becomes a liability when it's paid, when it's not paid on time. When you're late in payment, then you owe, it's a liability. And then an expense becomes a prepaid asset when you pay in advance. So when you pay an expense in advance, it becomes a prepaid asset. But when you do not pay an expense on time, it becomes a liability. So that's why you see when you don't pay, say, your mortgage on time, you get blacklisted because you are increasing what you owe. So you're increasing your liabilities. So if you pay on time, you're just paying the expense as it falls due, which is what you are expected to do. Or you can be too good and then pay in advance. That is also good. Prepaid income, this is a situation whereby someone has paid you, but you have not provided the service. So prepaid income becomes a current liability in the sense that you owe this person a service or you have to refund them their money. So prepaid income is a liability. And then current portion of long-term loan, this is the part of the long-term loan that you have not yet, that is falling due in a period of less than 12 months. So current portion of long-term loan is the portion, say you have a mortgage, and on this mortgage, you're going to be paying it partly each year. And then the portion that you're going to pay this year for the mortgage becomes your current portion of the long-term loan. So it's part of the long-term loan that is going to be paid in the near future. This is a period of less than 12 months to be repaid in less than a year. All these liabilities are the part of liabilities that you're going to repay in less than a year. So in a nutshell, this is how the accounting equation looks, and that's all the components that you have on the accounting equation. I hope you understand. Thank you.